Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'll be reporting flows for the week ended Wednesday, March 11th, 2015. Investors injected $23.5 billion into the conventional fund business. We will talk about ETFs as well, but can I just focus on the mutual fund side here real quick. This is the second week in three that actually seen some pretty big inflows, and this is on the 6th anniversary of the bull market, having a pretty good run. And what happened is investors actually heard some very good news, so it's good news equaled bad news, and investors, after hearing that there was very strong employment numbers, actually we heard that there was about 295,000 net new jobs added to the economy, and unemployment rate dropped about 5.5, and we heard also that quantitative easing was starting in the European zone. That investors really got kind of freaked out and concerned about the Fed probably raising interest rates sooner than they had expected. And I believe that's priced in the market anyway, so I think this is kind of a weekly blip on the radar. But nonetheless, we saw a really good inflow. So even though we saw some bad performance, again, the Dow was down. It's actually experienced its worst one-day drop in 5 months. Investors, I think, were just taking money off the table, kind of scared, maybe even looking for maybe some buying opportunities later on as well. But let's see how these news actually translated into flows for the conventional fund business. In our macro group, equity funds actually saw about $1.7 billion net new money come into their coffers. Taxable bond funds took in $2.1 billion. Muni bond funds took in about $78 million, so almost nothing to talk about there, or maybe even a rounding error. And money market funds actually saw the lion's share of net new money come into their group. $19.6 billion entered money market funds. And so obviously investors, while being concerned, putting money to work, actually put most of the money back to work into money market funds. Well, let's see on a breakout basis what happened to the equity funds and how flows actually translated there. Actually, we saw the second consecutive week of negative returns, 2.42% loss this week. Again, I told you it was pretty bad. People got a little freaked out. Certainly translated into equity funds as well. But we still saw about $1.7 billion net new money come into their coffers, third consecutive week of inflows. And how this broke out, if we break it out into domestic, non-domestic, domestic equity funds lost about $1.1 billion. This is the sixth consecutive week they've seen losses, so investors are actually running for the hills when it comes to domestic equity funds. But non-domestic equity funds, probably because of the result of the quantitative easing in Europe and other central banks actually becoming a little bit more easy in their monetary policies, actually saw some pretty handsome inflows, this time to the tune of about $2.8 billion. This is the fifth consecutive week that we've seen it. If I break out and take a look at domestic equity and see who the big loser was, large cap and small cap actually saw the biggest losses, about $0.8 billion for large cap, about $0.5 billion for small cap funds. And then if we take a flip side and take a look at international equities, again, investors were warming to that trend. $2.7 billion of inflows. And if I do a further breakout and take a look at emerging market Japanese funds, Pacific ex-Japan funds, and Pacific region funds, we saw about $1.3 billion in net flows into that group. So obviously investors going after some of the areas that were lagging, maybe lower in returns and expecting some better returns because of the quantitative easing program. Well, let's see how this actually translated into flows for ETFs. This is a whole different story. For the first week in 5, we actually saw outflows, about $700 million of outflows. And how that translated out is Wisdom Tree Japan Hedged Equity Fund ETF saw about $900 million of inflows. iShares MSCI EFA saw about $0.8 billion of net new money. But on the bottom side, with investors fleeing U.S. markets, we actually saw about $3.3 billion in outflow from the S&P 500, SPY, and then the iShares MSCI Emerging Market ETF actually saw about $500 million of outflows as well. So certainly kind of a tale of two cities when we're comparing retail investor behavior to the authorized participant behavior when we're talking about inflows to ETFs. Let's see how that actually works out for fixed income funds. It's pretty much the same story there. Fixed income funds on the conventional fund side, so about, for the 10th consecutive week, by the way, $2.1 billion of net new money coming into this week. It's the second consecutive week, however, that we saw negative returns, 0.83%. Certainly makes sense. We actually saw a jump in yield. People had flight to safety for a little while, driving yields down, but certainly saw a jump in yield to about 2.24%, later settled at about 2.11 during the week. So we've seen kind of a flip, but again, it has been on the rise, and of course that translated into some negative returns for the market as well. How it broke out, though, is that we saw corporate investment grade debt funds taking about $1.3 billion. This is the 10th consecutive week that they've seen inflows, and flexible portfolio funds actually saw inflows of, well, only about $300 million. It's the 7th consecutive week they've seen inflows. Now, we take a look, though, on the loan par side, and loan pars for the second week in 4, and it's the first time in like 36 months that they've actually seen inflows, saw some minor inflows, about $24 million, almost nothing to talk about. But, again, that might tell us a story that some people are starting to ramp up the idea that the interest rates may start rising. If so, maybe adjustable rate funds will be the appropriate place to go. Let's take a look at ETF and see what happened there. Here we see the tale of two cities once again. $3.9 billion in outflows, second consecutive week that we've seen outflows, and in fact this is the second worst outflow that we've seen for this group since March 5th, 2014. So certainly the retail investor is putting money to work back into fixed income funds. The authorized participant, the institutional investors, taking money out and running for cover. Power shares, Deutsche Bank, US dollar bull actually saw the biggest inflows, about $140 million, and the iShare iBox high yield corporate ETF saw the biggest outflows, about $1.3 billion, and iShares 20 plus Treasury ETF actually saw outflows as well, somewhere in the tune of about $800 million. So investors were getting rid of the high yield plays. You know, the risk on was definitely coming off the table. But on the flip side, they were also getting rid of Treasury because they felt at the long end of the curve certainly something was going to start to happen. I don't know if that's true or not, but that's certainly how they were behaving. Let's take a look at muni bond funds. They saw some slight inflows, about $78 million. That's probably a rounding error. It's the 10th consecutive week, though, that they've taken in net new money. So we have seen the trend there. This is the second week, however, that we've actually seen negative returns again, about a 0.27% loss for the weekend of Wednesday. And if we take a deeper dive into that, we see national munis actually took in about $121 million. And that would tell us that the single state munis have been taken on the chin. They actually lost some money as well. Well, let's turn our attention now to money market funds. And money market funds, as I told you, took in a lion's share. It's the second week in 3 that they've taken a big chunk of money, $19.6 billion. So while investors were, cozying up, retail investors were cozying up somewhat to equities and a few other, let's say, non-traditional type of fund types in international markets, they were actually putting money to work in money market funds. But how that traded out, if we take a look at it, institutional money actually saw the big inflows, $21 billion net new money coming into their coffers. And if we take a look at the retail side of money market funds, they saw outflows about $1.4 billion out. Tax-exempt money market funds saw about $24 million in outflow. That's almost a rounding error. So that's what brought us to our $19.6 billion in net new money coming into that coffer. Well, if we take a look now at what happened today, we had news on the retail sales for February coming in down 0.6%, lower than had been expected. And certainly we think that'll play through for the rest of the week, so we'll have to wait till next Wednesday to see what happens. Well, if you want to do a deeper dive, go into areas that I have not checked out, you can go to our site, www.lipperusfundflows.com, and do a deeper dive yourself. Or you can join us next week when one of our analysts will be talking to you about the flows of the week and what the trends and maybe even what these retail sales did to our flows for the week. Well, until next time, my name is Tom Rosine, wishing you the best in your wealth planning and creation.